Hello friends, good morning. In the previous sessions, we have already discussed about the basics introduction to the income tax and capital gains. Now we will go to profits and gains from business or profession, which is one of the important topic of direct taxation, where majority of the questions are going to be asked either in descriptive or objective. So when we comes to profits and gains from business or profession, it is profits or gains from business or profession. This starts with section 28. Section 28 to section 44. Section 44C deals with the provisions relating to profits and gains from business or profession. Here, section 28 says like this: any profits or gains arising from any activity relating to the business or profession would be chargeable to tax in the previous year in which such profits are arised in the hands of assessee. Here, profits or gains. Any profits or gains. Profits or gains can be of any nature other than capital profits. It deals with only revenue profits only, but does not deal with capital profits arising from business or profession. Business has been defined under the Income Tax Act, where the business includes any activity which is of regular nature, or which is even if the business is irregular nature, it will be covered under the topic of business only. Even if the person has done the activity for one day in the previous year, it is deemed that the person has done the business for that year, for that previous year. And we will go to next topic is profession. Profession has been defined under section. Profession has been defined under Income Tax Act. Profession includes those professions that have been notified under section 44AA. Those are 44AA. What is 44AA? 44AA is the section that says the compulsory maintenance of books of accounts. The following persons who are required to maintain the books of accounts has been defined under section 44AA. Now, when we comes to business or profession, person has been defined under section 2 subsection 31. We have already discussed person, and assessment year, previous year, we have already discussed in the previous sessions. So what are the definitions of assessment year, what is the definition of previous year, and everything. Now we will go to what are the types of income that are included in profits and gains from business or profession. First one is any keyman insurance, any policy amount that has been received under keyman insurance policy will be chargeable under the Pgbp, and any income that is arising from conversion of capital stock in trade into capital asset will be chargeable under the head Pgbp. Any perquisites that have been provided by the employer to the employee will be chargeable under the head Pgbp, and any profits, any gains that are arising from the sale of duty free and duty free replenishment certificate or duty free entitlement passbook scheme, and all these are covered under all these types of incomes are covered under section P, under the topic Pgbp. And any gains that are arising from any amount that has been received under non-compete fees or non-compete fees not to perform the contract, and any income that is arising from various other activities. Other activities includes which are in the form of regular revenue in nature only, will be covered under the head Pgbp. Section 28. Now we will go to section 145. Section 145 deals with the method of accounting. It says about method of accounting. The method of accounting here, the method of accounting followed by the assessee can be either accrual system or cash system, whichever is regularly employed by the assessee. Assessee will be the method of accounting. He can follow the accrual system or he can follow the cash system. Depending upon the accrual system or cash system, the Pgbp, profits and gains from business or profession, are taxable. Now section 145 subsection 2 deals with ICDS, that is income computation and disclosure standards. Like we have the accounting standards or Indian accounting standards as per accounting, as per accounting, we also have, as per income tax, we have income computation and disclosure standards, where the income has to be computed as per these standards only. Now section 29. What is section 29? Section 29 deals with the mode of computation of Pgbp. Here, what is the method of computation of Pgbp? Here first we will take the net profit net profit or loss as per the profit and loss account we will take into consideration. For this we have to add certain additions, we have to do certain deletions. So what we have to add, what we have to delete, we have to add what we have to add any expenses that are inadmissible that are not allowed as deduction. We have to add back those expenses. So any incomes that are that are already covered under the respective heads cannot be covered under PGBP. So we have to reduce those incomes, and any expenses what we have to less, any expenses that are required to be allowed as deduction we have to less, and what we have to add, any incomes that are required to be taxable under the head PGBP we have to add. Then we will get the profits and gains from business or profession which are going to be taxable. Any losses arising from profits and gains from business or profession can be set off against profits as per intra-head adjustment, and any it can be carried forward for the further assessment years for a period of 8 assessment years, and this profits and loss from profits and gains from business or profession can be set off against any other head other than salaries. Obviously, if the person is individual, if the person is company, the salaries income will not be available. For if the person is an individual, then only salaries income is available. Other than salaries income, it can be adjusted against any other income. It's loss from PGBP, and here the thing you have to remember is section 30. Section 30 deals with what? Section 30 deals with rent, rates, taxes, rent, rates, taxes, and insurance relating to the immovable property, that is property includes immovable property, land and building, you can say land and building. So in relation to two types, first one is in respect of assessee, that is owner, and in respect of tenant. In respect of owner and in respect of tenant, to whom these are taxable, these are available as deduction. First thing is in respect of rent. In respect of rent, tenant, obviously owner, it will not be allowed as deduction because self-proclaimed or notional rent cannot be allowed as deduction as per PGBP. Now in respect of tenant, it will be allowed as deduction because it is revenue expenditure and it has been incurred for the purpose of business or profession, so it will be allowed as deduction. In respect of rates, whatever the rates that have been incurred by the assessee or either assessee or tenant, it will be allowed as deduction in the hands of both persons. Now in respect of rent, rates, taxes or municipal taxes, so whatever the municipal taxes that have been paid, or in respect of rates and taxes, so one section we have to remember immediately. What is that section is? Section 43B. Section 43B is what it tells. So any expenses that have been incurred for the purpose of business or profession will be allowed as deduction only on payment basis. Those type of expenses includes rates and taxes also. Taxes, so only tax this will not be available on due basis, but will be available on receipt basis or payment basis. As per section 43B. Now rent, rates, taxes we have seen, it will be allowed as deduction in the hands of both owner and in the hands of tenant. Taxes, duties, any type of duty that have been incurred in the hands of by the owner or by the tenant, in the hands of both persons, it will be allowed as deduction. Now we will comes to taxes. Insurance premium, any insurance premium that has been incurred, insurance premium that has been incurred by the assessee or by the owner or by the tenant will be allowed as deduction. In respect of repairs, repair expenses are allowed as deduction. Here repair expenses are divided into two categories: revenue repairs and capital repairs. Revenue repairs are allowed in the hands of owner and in the hands of tenant as deduction from PGBP, but capital repairs will not be allowed as deduction in the hands of owner, in the hands of tenant. It will be added back to cost of the asset, and depreciation will be available. Depreciation will be available only in respect of owner. If the repairs has been incurred by the capital repairs has been incurred by the tenant, even it has been incurred by the tenant, depreciation will be available for the tenant also. This is section 30. Section 31 deals with what? Section 31 deals with rent, rates, taxes, insurance premium and repairs relating to plant and machinery and equipment. In respect of plant and machinery and equipment, owner and tenant. In respect of owner and tenant, for owner obviously rental expense is not available, not allowed as deduction because self-proclaimed rent or any notional rent will not be allowed as deduction. In respect of tenant, whatever the tenant rental expense that has been incurred will be allowed as deduction from the PGBP, and rates and taxes, these two are allowed as deduction in the hands of owner, in the hands of tenant. Rent, rates, taxes, duties, and any duties that have been paid in respect of owner and in respect of tenant, both will be allowed as deduction. And insurance premium and repairs. Insurance premium, in respect of insurance premium, both deduction is allowed in respect of owner and in respect of tenant, and in respect of insurance premium, and next one is what? Next one is in with respect to repairs. Repairs are here also repairs are two categories. So revenue repairs and capital repairs. Revenue repairs will be allowed a deduction in the hands of owner and in the hands of tenant, and capital repairs will not be allowed. Capital repairs will not be allowed a deduction in the hands of owner and in the hands of tenant. But here it will be added to the cost of the asset and depreciation will be claimed. And here when we say that repairs are capital in nature, when the repairs that are incurred for the plant and machinery or asset will improve the performance of the asset, or will improve the performance of the asset than that is previously performed before carrying out that repairs, then we can say that those repairs are capital in nature and we have to add to the cost of the asset, and depreciation will be claimed against those repairs that have been incurred as deduction from Pgbp. This is section 31. Section 32. Section 32 deals with what? Depreciation. Depreciation, which is mandatorily required to be incurred and required to be deducted from, required to be allowed and required to be deducted from the Pgbp. Without depreciation, in any situation, depreciation has to be provided mandatorily as per the Income Tax Act. So here depreciation, when depreciation will be allowed. Here the asset should be owned by the assessee. Owned by the assessee during the previous year. Asset means here owned by the assessee. Owned means assessee can be a legal owner or original owner or real owner. He can be a beneficial owner. Even though he is a beneficial owner, for him depreciation will be available. Beneficial owner means, for example, if you take an example of hire purchase agreement, here depreciation can be allowed for the hire purchaser. For the hire purchaser, depreciation will be allowed. But in respect of hire purchaser, depreciation will be allowed. Hire purchasee, depreciation will be allowed because he is a beneficial owner of the asset. But in respect of transactions that are relating to hire or lease or rental of any property, then in that situation, so depreciation will be available in respect of owner of the asset, that is lessor only, but not lessee. Lessee is the beneficial person, but the real owner is what? Real owner of the property is lessor. So lessor will get the depreciation in his books of accounts, and lessee cannot claim depreciation. Now it should be put to use or available for use during the previous year. And it should be it should be put to use or available for use during the previous year. The thing is, the asset should be put to use during the previous year. Put to use means it should be ready for use. Even if in order to claim depreciation by the assessee, even the asset is ready for use, then it is sufficient to claim the depreciation. It is not required that the asset should be compulsorily put to use during the previous year. For example, if you take an example of fire extinguishers, or if you take an example of any other gadgets of safety equipment, all these are standby equipment and service equipment. All these are what? All these are the items which are ready for use or available for use, but these are not put to use during the previous year. But the assessee can claim depreciation in respect of those assets also, if those assets are used for the purpose of business or profession. In the similar manner, who can use the those assets that are used for the purpose of business or profession only, depreciation can be claimed. The assets which are not used for the purpose of business or profession, but there is personal assets that are, for example, ACs that are installed in residential house of the owner, or residential house of any of his relatives. So here, for those assets, the assessee cannot claim depreciation because those are not used for the purpose of business or profession. So the assessee cannot claim depreciation. Now, when it comes to depreciation, here depreciation rates, the method of computation of depreciation. Here two types of depreciation. First one is depreciation relating to the activity relating to production, generation and distribution of electricity, power generating units. So for power generating units, depreciation has been provided under depreciation has been provided under 32 subsection 1 clause 1. Just wait. Depreciation has been provided under 32 subsection 1 clause 1, and 32 subsection 1 clause 2 deals with depreciation relating to any other assessees, all other assessees. In respect of power generating units, the rates have been provided under Rule 5 Subrule 1, and rates has been provided, and it is straight line method of depreciation. Means power generating units can follow the straight line method of depreciation. And when it comes to other assessees, depreciation has been provided. Depreciation can be allowed on WDV basis, that is return on value basis, and the percentage of the rates of depreciation has been provided under Rule 5. Rule 5. Now will comes to what will comes to types of depreciation. The types of depreciation, there are three types of depreciation. First one is types of depreciation include three types. First one is normal depreciation, second one is reduced depreciation, third one is additional depreciation. Normal depreciation means if the asset has been put to use for a period of more than or equals to 180 days, more than or equal to more than 180 days, then the person can claim full amount as depreciation. Means if the person the asset has been put to use before 4th September of the relevant previous year, then he can claim full amount of depreciation. If the asset has been put to use after 4th of September of relevant previous year, he can claim reduced depreciation, that is half rate of depreciation. Depreciation is available. That is reduced depreciation. Additional depreciation is what? Additional depreciation will comes to we will further discuss what is meant by additional depreciation. Now we will discuss about in respect of power generating units. Power generating units. The power generating units, what they have done, they have claimed depreciation, and subsequently the assets have been sold. If the assets has been sold by the power generating unit subsequently, then in that situation what happens? The sale proceeds relating to assets can be more than WDV, it can be less than WDV. If it is more than WDV, means the sale proceeds are more than WDV, then in the 43 subsection 1, if the sale proceeds are more than WDV, then in that situation the excess amount of sale proceeds over and above the WDV will be taxable under the head of profits and gains from business or profession. If the sale proceeds are less than WDV, if the sale proceeds are up to the amount of WDV plus the previously provided depreciation, then if it is up to that much, then it is called as balancing charge. It is called as balancing charge under 41 subsection 3. 41 subsection 3, it is called as balancing charge, and any amount that has been received over and above the current WDV value plus the depreciation that has been already charged in the previous years, excess amount will be taxable at capital gains, short-term capital gains. We will treat it as short-term capital gains, and it will be taxable under section 50. Under section 50, it will be taxable. Now we will comes to what? Now we will comes to the rates of depreciation. Rates of depreciation, obviously, it has been provided under respective rules. Rates of depreciation. For buildings are divided into three categories. First one is buildings that are used for residential purpose, buildings that are used for business purpose, and buildings that are used for temporary structures. Buildings that are temporary structures. In respect of residential purpose, 5% rate of depreciation is available. In respect of business purpose, 10% rate of depreciation is available. In respect of temporary structures, 40% rate of depreciation is available. Plant and machinery, obviously 15% rate of depreciation is available. And motor vehicles that are divided into two categories, that are running them on hire, that are used for business or profession. If they are running them on hire, then 30% of rate of depreciation is available. If they are used for the purpose of business or profession, 15% rate of depreciation is available. If these motor vehicles are acquired between 23/8/2020 to 2019 to 31/3/2020, then in this period, then the rate that will be available for the motor vehicles that are used for running them on hire is 45%. In respect of normal motor vehicles, the rate that is available is 30%. Now we will go to ships. For ships, depreciation rate is 20%. For ships, depreciation rate is 20%, and for intangible assets, depreciation rate is 25%, and for all other assets, that is either books, operators, books and all other equipments, windmills, energy saving equipments, all these are the items. Depreciation rate is 40%. Highest depreciation rate is 40%, and computers and computer operators also depreciation rate is 40%. Here EPABX and EPABs, what we call EPABX, EPABs and these are not considered as computer related equipment, not treated as computers. So higher rate of depreciation 40% is not available. And in respect of computer accessories, UPS, printers, and printers, for all these, these will be considered as computers, and higher rate of depreciation 40% is available in respect of these assets. Now, in respect of plant and machinery, what is the definition of plant and machinery? Plant and machinery includes includes some items, plant and machinery excludes some items. So plant and machinery includes books, scientific operators, surgical equipments, and equipment. Equipment, all these are included in plant and machinery. It excludes what? Buildings and towers will be included in plant and machinery. It excludes what? It excludes livestock. It excludes telecommunication towers, pipelines that are laid within the factory, and forklifts that are used within the office, within the factory premises. So all these are excluded from the definition of plant and machinery. Now we'll go to what sorry. We will go to next concept is additional depreciation. Additional depreciation means here if the section additional depreciation has been provided under section 32 subsection 1 clause 2a. Here in respect of normal apart from normal depreciation, additional depreciation of 20% is available for the assessee if the assessee has purchased new plant and machinery. Here the thing is, when you talk about additional depreciation, this additional depreciation is not allowed as deduction under some of the optional schemes, that is section 115 BA, BAB, BAA, BAB, BAC, BAD. Section 32 subsection 1 clause 2a is not available. Even the carry forward unabsorbed depreciation of additional depreciation is also not available in respect of those sections. Do you remember? Yes. Now we'll go to new plant and machinery. The assessee has to purchase new plant and machinery during the previous year. On this new plant and machinery only additional depreciation at the rate of 20% is available. However, if this additional depreciation in respect of this additional depreciation, there will be if the assets are put to use for a period less than or equal to 180 days, then the depreciation will be half. Means only half or rate of depreciation, 10% of the depreciation will be allowed as a reduction in that previous year. In the subsequent previous year, immediately succeeding previous year, another 10% depreciation is available. This additional depreciation is available for all types of equipment. So, but it excludes some of the equipment. So, what will not be considered as a new plant and machinery? Those are items in respect of which 100% reduction has been claimed by the assessee under section 35 under section 35 AD or 35. Here we will discuss further later what are the sections where the person can claim 100% of deduction. Assessee can claim 100% of deduction in respect of those assets. And second one is those assets where assessee can those assets where the assessee can assessee has installed in his residential office premises, residential houses or office premises, office and that is ACs and TVs and generators. So all these will not be considered as a new plant and machinery. And second-hand plant and machinery obviously will not be considered as new plant and machinery. Plant and machinery that has been imported from the outside countries will not be considered as new plant and machinery. It will be considered as a old plant and machinery only, and normal depreciation it is available, but additional depreciation of 20% will not be available. Next, for example, there is a situation where during the previous year, if the assessee does not have necessary profits against which the depreciation for that year can be allowed as reduction, then there will be unabsorbed depreciation for that will be available for that year. This unabsorbed depreciation which cannot be allowed as reduction, or which is not where there is no sufficient profit available for the purpose of deduction, then this unabsorbed depreciation can be carried forward and set off as normal depreciation for the unlimited years indefinitely. It can be carried forward. There is no time limit, there is no expiry, there is no limit where the depreciation, unabsorbed depreciation will be expired. It will never be expired until the business season continues. If the business is shut down, obviously unabsorbed depreciation will be expired. Otherwise, the unabsorbed depreciation will never expire. What is the order of set off? Order of set off is first, against the profit of the business during the previous year. First, we will have to reduce depreciation, which is a mandatory, which is required to be deducted. Next, we will reduce brought forward business losses, because brought forward business losses, these losses will have the expiry period or expiration period which is less than unabsorbed depreciation. So it will be allowed a deduction, brought forward business losses. Third one is unabsorbed depreciation. So this is the order of set off. Unabsorbed depreciation can be set off against any other income, but unless it cannot be allowed to set off against salaries. Because if the assessee is an individual, salaries income is available. If the assessee is not an individual, salary income is obviously not available. for deduction. Now we'll go to what? We will go to section we will go to section 43 subsection 1. Section 43 subsection 1 deals with what? Section 43 subsection 1 deals with actual cost. Actual cost means the cost of the asset. Here when we discuss about the cost of the asset, here two things happens. We do cost of the asset includes some items, or cost of the asset excludes some items. What are the items that are included in the cost of the asset? Cost of the asset includes purchase price. It also includes what? It also includes any expenses that have been directly incurred for bringing the asset into present location and condition. Condition will also be included in the cost of the asset. It also includes what? It also includes any test run and trial run expenses will be included in the cost of the asset. Here test run, this is as per the test run or trial run expenses will be included in cost of the asset. Now it also includes any as per Ind AS ICDS 5, which is related to what? Which is related to tangible assets. Tangible assets. All the expenses that have been incurred in bringing the asset into present location and condition will be included in the cost of the asset, and these expenses will also include expenses will also include any expenses that have been incurred by the assessee will be included in the cost of the asset. Now this is as per ICDS 5. Now we'll go to interest expenses. Any interest that has been incurred. Any interest that has been incurred by the assessee for on the borrowed funds which have been utilized for the purpose of acquiring of the asset up to the date on which up to which the asset is put to use will be capitalized and will be added to the cost of the asset, and depreciation will be allowed as reduction. And those interest that has been incurred after the asset is put to use, it will be allowed as reduction against Pgbp income as revenue expenditure. Here the thing is, this interest expense includes what? Interest expense includes all type of expenses, commission charges, commitment charges, and any penal charges, any fees, or any charges that have been incurred, or any commission that has been paid for the purpose of arranging of loans, for the purpose of getting the loans approved. All these expenses will be included in interest or borrowing cost and will be added to the cost of the asset. Here the thing is, here the asset can be divided into two categories. First one is qualifying asset, other assets. Interest that has been incurred in construction, production and production of qualifying asset will be added to the cost of the asset. Will be developing construction production of qualifying asset will be added to the cost of the asset, because these interest expenditure has a enduring benefit, so it will be added to the cost of the asset. Any other borrowed funds which are not incurred for the purpose of qualifying asset will not be added to the cost of the asset. It will be debited to profit and loss account as revenue expenditure. Now one thing we have to remember here is what we have to remember here: exchange differences. Any exchange differences there are, or any foreign exchange fluctuations that arises on funds that have been borrowed from the foreign countries in foreign currency, this will be added to the cost of the asset up to the period up to which the funds has been asset has been first put to use. If the asset has been put to use, after the asset has been put to use, these foreign exchange fluctuations cannot be adjusted against the cost of the asset. It will be obviously debited to profit and loss account as revenue expenditure. Now this is in respect of foreign exchange fluctuations. Now we will go to what? Now we will move to this has been provided under ICDS 9. ICDS 9 deals with effects of changes in foreign exchange rates. These foreign exchange rates can be in respect of monetary items, non-monetary items. In respect of non-monetary items, the foreign exchange rates has to be. The effects of changes in foreign exchange rates has to be adjusted against the cost of the asset. This is as per ICDS 9. Now we will go to what? We will go to items which are not included in the cost of the asset. Any incidental income that has been received will not be included in cost of the asset. It will be excluded. Any expenditure that any initial operating losses or any initial operating losses or any expenditure, any permanent expenditure that has been incurred on trial run, and any wages or any salary that have been paid to the employees, all this will not be included in the cost of the asset. It will be debited to profit and loss account. And obviously this will not be included in the cost of the asset. It will be debited to profit and loss account. And here the thing is, the asset, if the asset has been used by the assessee for the purpose of business or profession against which 100% of deduction is claimed under section 35 or 35 AD, then the actual cost of the asset will be what? Actual cost of the asset will be nil. In respect of assets which are used by the assets which have been transferred and are acquired by the assessee under sale and leaseback arrangement, then in that situation the reacquired price or the original price minus WDV value of the previous owner will be, whichever is lower, will be considered as the actual cost for the purpose of claiming depreciation. Next, if the assets has been transferred to other person with an intention, or second-hand plant and machinery has been acquired with an intention to claim a higher depreciation or to avoid income tax, then the assessing officer, with the permission of Joint Commissioner of Income Tax, will determine the WDV value of the assets. And assets which are acquired under gift or will or irrevocable trust, then in that situation it will be WDV of the previous owner. If the assets have been acquired under amalgamation or demerger or conversion of sole proprietorship into company, or in all these cases it will be WDV of the amalgamating company or resulting demerged company and here the depreciation, in respect of depreciation will be allowed in respect of amalgamation case and demerger case. Depreciation will be allowed between two entities depending upon the number of days asset has been put to use by the assessees in the respective previous years. In the respective previous years, depreciation will be allowed proportionately to those entities. Now depreciation will be allowed proportionately to those entities. Now we will I think I have completely discussed with you all the topics relating to depreciation. Let me check once. Yeah, mode of computation of depreciation. How we will compute the depreciation? First, in respect of depreciation, first we will take what? We will take the opening WDV of the assets. For that, we have to add any additions that have been made during the previous year where the assets has been used for a period of more than or equal to 180 days. We have to add. We have to reduce what? We have to add assets which are being put to use for a period less than or equal to 180 days. We will add, and we will reduce assets that have been discarded, sold, or monies that have been received in respect of assets which have been discarded or sold. We have to reduce, then we will get a closing WDV value. We will get what? We will get closing WDV value. And in respect of interest on capital borrowed will not be allowed as deduction. If the capital for the period for which after the asset is put to use will not be added to the cost of the asset. It will be debited to profit and loss account. This is already we have discussed. Any subsidies that have been received from the government, or any grants that have been received will not be included in cost of the asset, and any expenditure that has been incurred by any other person, or any expenditure that has been reimbursed by any other person in respect of the asset, it will not be included in cost of the asset. And any expenditure that has been incurred excess of 10,000 rupees in cash will not be added to the cost of the asset. And government grants, recognition of government grants. Here, when the government grants are recognized, ICDS 7, as per ICDS 7, government grants are recognized when there is reasonable certainty that grant will be received, then the government grants will be recognized. Here, what is the treatment of government grants? In respect of depreciable assets, in respect of non-depreciable assets. In respect of depreciable assets, it will be reduced from the cost of the asset. It will be reduced from the cost of the asset on net balance. Depreciation will be claimed. In respect of non-depreciable assets, recognized as income, deferred income over the period against which the asset has been used. Asset has been meeting of obligation charged to the income. Next, in respect of financial support, any financial support or any losses incurred or compensation expenses paid recognized as income for the period which is receivable, power subsidy, transport subsidy, all this will not be included in cost of the asset. Non-monetary assets recognized as acquisition costs and refund of government grants. If the government grants are refunded, in respect of refund of government grants relating to non-monetary assets, non-depreciable assets, and government grants related to depreciable assets. In respect of non-depreciable assets, adjusted against unamortized amount of the excess amount of balance will be refunded, will be charged to profit and loss account. In respect of non-depreciable assets, in respect of depreciable assets, what we will do? In respect of depreciable assets, it will be added to actual cost or WDV of the amount refundable, on which depreciation will be added to the cost of the asset, and depreciation will be claimed on the remaining balance after on the balance amount. This will not be included in this. Will obviously cash purchases we have already discussed. And in respect of treatment of foreign exchange fluctuations, here non-monetary items, monetary items, and forward contracts and derivative contracts. In respect of non-monetary items, fixed assets or inventories or investments recognized in profit and loss account only when at the time of transaction it will be charged to profit and loss account. In respect of monetary items, assets that have been received or liabilities that have been settled in fixed and determinable units of currency, recognition on mark-to-market basis. In respect of forward contracts and derivative contracts, and if they are used for hedging, if they are used for speculative purposes, if they are used for hedging, then it will be exchange differences will be recognized on pro rata basis over the life of the hedging contract. If it is used for speculative purposes, exchange differences will be recognized or to profit and loss account at the end of the on the settlement of the contract. Exchange differences will be recognized to profit and loss account on the settlement of the contract. Next, any actual cost, inventories that are used. Additional depreciation we have already discussed, and method of depreciation. What is the order of set off in respect of unabsorbed depreciation we have already discussed. Now we will go to allowances. Under section 30. Section 36 deals with all types of allowances. These allowances are divided into three categories. First one is allowances which are related to employment, allowances which are related to finance, and other type of allowances. Allowances which are related to employment. Here in respect of employment, what are the allowances? Any insurance premium that has been paid by the employer for the health of the employees will be allowed a deduction. This is section 32 subsection 1, 36 subsection 1, clause 2, clause 1A, clause 1B. Clause 1B, 32 subsection 1, clause 2 is any commission or any bonus that has been paid by the employer to the employees otherwise than as by way of distribution of profits will be allowed as a deduction. 32 subsection 1, clause 2. Next, 36 subsection 1, clause 2. 36 subsection 1, clause 4 is what? Clause 4 is any contribution that has been made by the employer towards provident fund or gratuity fund recognized will be allowed a deduction. 36 subsection 1, clause 4. 36 subsection 1, clause 5 is any contribution that has been made by the employer to the pension to the gratuity fund of employees will be allowed as deduction. Here provision for gratuity will not be allowed as deduction, but contribution on gratuity fund will be, any contribution that has been made for gratuity fund will be allowed as deduction on payment basis only. 40 capital A subclause 7 deals with any any provision that has been made against the gratuity fund will not be allowed a reduction, even it is based upon actuarial purposes also it will not be allowed a reduction. No? 40 capital A subclause 9. Subclause 9 deals with any expenses, any contribution that has been made by the employer to the unrecognized provident fund or unrecognized gratuity fund, unrecognized superannuation fund or any other welfare fund will not be allowed as reduction, will be added to, will be disallowed. Here the thing is, here these are divided into categories: recognized provident funds and unrecognized provident funds. Recognized provident funds are recognized under the Employee Provident Fund and Miscellaneous Provisions Act, or Employee Provident Fund and Miscellaneous Provisions Act, and in respect of any other act or Income Tax Act has specifically recognized these funds for the purpose of deduction, then that will be considered as recognized provident funds, and all other types of funds will be recognized as unrecognized provident funds. Next, now let's come to section 36 subsection 1 clause 5a. 36 subsection 1 clause 5a is any contribution that has been made by the employees for the pension fund, superannuation fund, gratuity fund will be allowed as a deduction, provided the amount has been deposited by the employer within the due date of the fund, but not due date of the return of income. Within the due date of the fund, he has to deposit with the fund. Otherwise, it will not be allowed a reduction. Here, as per 2 subsection 24 clause 10, first it will be this amount, the amount that has been contributed by the employees received by the employer will be treated as income in the hands of employer and under the respective head, and again it will be allowed a reduction under 36 subsection 1 clause 5a. Clause 5a. Next, any income, any contribution that has been made by the 36 section 1 clause 6a, Shashan Chemicals Private Limited, Supreme Court, in case of Shashan Chemicals Private Limited, where any contribution that has been made, the assessee has made contribution to the trust or the made payment to the trust, and the trust has made payment to the employees. The assessee can the assessing officer contemplated that as the assessee has not paid directly to the employees, but the trust has paid, so deduction will not be available in the hands of assessee. But the Supreme Court said that even though the assessee has not paid, the trust has paid, substance based upon the principle of substance over form. In substance, the ultimate payment that has been received by the employees only, whether it is paid by the assessee or it is paid either directly by the assessee or indirectly by the assessee, it will be allowed a reduction in the hands of assessee. And any provisions not available for 30 subsection 1 clause 5a. Provisions of section 43b means deduction on payment basis will not be available in the hands in respect of 36 subsection 1 clause 5a. Means even if it is on due basis also deduction will be available. Means it is not necessary that employer is required to receive the contributions from the employees regular on payment basis, on receipt basis. Even it is based upon due basis also, it will be allowed a deduction in the hands of employer. Next, that 6a is employer contribution to the pension fund under 80 CCD subsection 80 CCD will be allowed a deduction in the hands of employer. Clause 6a, it will be allowed a reduction in the hands of employer. This is employment related. Now we will go to what? We will go to finance related. Finance related is what? Finance related is any interest that has been incurred, on borrowed funds that has been utilized for the business of production will be allowed as a reduction. Interest on capital borrowed for use for purpose of business of production. 36 subsection 1 clause 3. 36 subsection 1 clause 3d is any discount on zero coupon bonds. Zero coupon bonds will be allowed as a deduction over the period of life of the bond. It will be allowed as a reduction under 36 subsection 1 clause 3d. Now we'll go to another section, that is 36 subsection 1 clause 7. Clause 36 subsection 1 clause 7. Clause 7 is bad debts. Bad debts are here. In respect of bad debts, when it comes to bad debts will be allowed a reduction only when the debt has been become irrecoverable in the previous year. Then only it will be allowed a reduction. Even if the bad debts are not recognized in books of accounts, but as per ICDS, bad debts are recognized, then it will be allowed a reduction under 36 subsection 1 clause 7. If subsequently if the bad debts have been recovered, then it will be taxable under section 41 subsection 3 as deemed income in the year of recovery. In the year of recovery, here here recovery of bad debts is divided into two categories. First category is recovery amount is more than the bad debts allowed, or difference between bad debts incurred minus bad debts allowed. Then excess amount will be taxable under 41 subsection 3. 41 subsection 3 as deemed income. If the bad debts amount recovered is less than bad debts minus bad debts allowed, then the deficient amount will be allowed as deduction. Will be allowed as a deduction under 36 subsection 2. Next, in respect of if the bad debts relating to in case of PK Kamal Madras High Court case, bad debts that are incurred by the predecessor can be allowed as deduction for successor. In case of Veerabhadra Rao Koteshwar Rao case, any bad debts that have been incurred by the written off by the successor after succession of the business will be allowed as deduction for the successor. Bad debts incurred by the predecessor but written off by the successor after succession of the business will be allowed as deduction. Next, in respect of income we have discussed, any debt we have discussed, and now we'll go to what? We'll go to provision for bad debts. Provision for bad debts is 36 subsection 1 clause 7A deals with provision for bad debts. Provision for bad debts is allowed as deduction only for specified entities. It is not available for all the entities, all the assessees. Specified entities are divided into three categories. First one is foreign banks, second one is scheduled banks, third one is foreign banks, scheduled banks, and foreign banks, scheduled banks. Third one is financial institutions. In respect of financial institutions, state financial corporation or state and public financial corporation, deduction that is available is 5% of the total income without providing deduction under chapter 6A. In respect of public sector foreign banks, deduction that is available is 5% of the total income without allowing deduction under chapter 6A. In respect of scheduled banks, 8.5% of the total income plus 10% of aggregate average of the rural advances will be allowed as deduction. Deduction. Here this is in respect of scheduled banks. In respect of scheduled banks and provision for it is a concept of provision for bad debts. Now we'll go to eligible. What is the eligible? In respect of 30 subsection 1 clause 8, what is 30 subsection 1 clause 8 is any contribution that has been made to the specific fund will be allowed as special reserve will be allowed as a deduction. What is the what are the businesses that are eligible? Here the businesses that are eligible are scheduled banks, foreign banks, scheduled banks, and state financial corporations, public financial corporations which have made arrangements for long-term finance, long-term industrial and agricultural development, long-term finance for infra projects for all these entities. Any contribution that has been made to the special reserve will be allowed as reduction. Any withdrawal from the amount 20% of Pgbp, reduction amount is for 20% of Pgbp or 200% of share capital plus free reserves minus contribution that has been made, or actual amount of contribution that has been made, whichever is lower will be allowed a reduction. And here any amount that has been withdrawn from special reserve will be deemed to be the income in the year in which it has been withdrawn. Next, 36 subsection 1 clause 8 clause 9 is what? 36 subsection 1 clause 9 is any deduction in respect of family planning expenditure. Deduction in respect of family planning expenditure, it is available for all the SSCs. Here deduction that is available is 1/3 of the 1/5 of the total expenditure. 1/5 of the total expenditure will be allowed a reduction. Here capital expenditure will not be allowed. Revenue expenditure fully allowed a reduction. Capital expenditure 1/5 of the total expenditure incurred will be allowed a reduction over the period of 5 years. Unabsorbed capital expenditure can be allowed to carry forward for the future years and can be set off like unabsorbed depreciation. Same in respect of any assets that have been acquired under family planning expenditure, if those assets have been transferred, same balancing charge, what is the treatment under 41 subsection 3, same treatment applies here also. And other in respect of other deductions are what? Other in respect of deductions relating to any premium that has been paid in respect of insurance of cattle will be allowed a reduction in milk cooperative society. So next one is any insurance premium that has been paid for the stock or stock in trade will be allowed a reduction under that is section 1 clause 1. And any loss that has been incurred on death of death of the animals, then amount that has been recovered minus carcasses will be amount that has been incurred minus carcasses that has been received, amount that has been received on sale of carcasses, remaining amount will be allowed as a reduction. Next, remaining type of allowances are any commodities transaction tax that has been paid, or any securities transaction tax that has been paid, or any mark to market losses that has been incurred will be allowed a reduction. And any amount, any expense that has been incurred on purchase of sugar cane at maximum minimum selling price fixed by the government will be allowed a reduction. All these are miscellaneous allowances which will be allowed a reduction. 36 subsequent clause 18 deals with mark to market losses. 36 subsequent clause 17 deals with commodity transaction tax. 36 subsequent clause 16 deals with security transaction tax, and 36 subsequent clause 14 I think so. 36 subsection 1 clause 14 deals with clause 14 deals with contribution made by the public financial institution to the credit guarantee fund. Clause 15 deals with security transaction tax. Clause 16 deals with commodity transaction tax, and clause 17 deals with expenditure incurred by the cooperative society for purchase of sugar cane fixed by the government. And 36 section 1 clause 3A deals with the discount on zero coupon bonds. Discount on zero coupon bonds will be allowed as reduction over the period over which the life of the bond. It will be allowed a reduction, discount divided by life of the bond, and any will be allowed as reduction. These are additional allowances, remaining allowances that are available as reduction under 36 subsection 1. Now we will go to what? We will go to section 40. Section 40 deals with what? Section 40 deals with disallowances. So here section 40 subsection this is as follows. Section 40 subsection 1 1 small a deals with any expense that has been made by the assessee to the non-resident where the TDS is required to be deducted but not deducted, or TDS has been deducted but not paid to the central government account within the due date of furnishing of return of income, then the excess the amount that has been not been paid, 100% of such expenditure will be disallowed for the previous year. Here exceptions to this is what? First proviso to section 41 small a is it will be allowed a reduction in the it will be allowed a reduction in the previous year in which the TDS has been deposited. And second one is the assessee will not be treated as assessee in case of assessee will be treated as assessee in case of default under 201 subsection 1, where assessee cannot be treated as assessee in case of default if the person to whom the amount has been paid has shown that amount in the return of income filed by him and paid the respective taxes on that amount, and file a statement to the assessing officer, see a certificate to the assessing officer regarding that income, then the assessee cannot be treated as assessee in case of default, and interest obligations will not arise. This is the 36 section 40 small 1 small a, and section 40 small subsection 1 clause 1a. Clause 1a deals with what? Any expenditure that has been incurred by the assessee in respect of payment that has been made to the resident individuals where the TDS is required to be deducted but not deducted, or TDS is deducted but not paid to the central government account within the due date of furnishing of return of income, then 30% of the expenditure incurred will be disallowed, and first provision, second provision will be obviously applicable. It will be allowed a reduction in the previous year in which it has been actually paid, and it will be allowed a reduction in the previous year in which it has been actually paid. And here the person who has to whom it will be allowed a reduction in the previous year in which it has been actually paid. And if the person has the person will be treated as assessee in case of default. The person will not be treated as assessee in case of default if the amount has been shown in the return of income by the person and paid respective taxes on that amount, then assessee cannot be treated as assessee in case of default. Section 40 subsection 1 clause 1b deals with what equalization levy. Any person who has made payment to the non-resident where equalization levy is required to be deducted but not deducted, or equalization levy has been deducted but not paid to the central government, then 100% of the expenditure incurred will be disallowed, and it will be allowed a reduction in the previous year in which the equalization levy has been deposited, and assessee will be treated as assessee in case of default. Assessee will not be will be treated as assessee in case of default otherwise. Next, section 40. This is section section 40 subsection 1 small section 40a small b. Now section 40 small b deals with section 4. Supreme Court in Palam Gas Service Limited, it has been held that provisions of section 40a small a shall apply to be paid as well as payable basis also. Section 40a subsection 2 deals with any payment, any rates and taxes that are levied will be allowed as will be disallowed. That is any rates and taxes includes what any income tax, any TDS or any advance tax that has been paid, it will be disallowed. It will not be allowed a reduction. This includes surcharge and cess also. Next, section 40a subsection 3 deals with 2a deals with any wealth tax paid will not be allowed a reduction. 40a subsection 3 deals with any TDS that has been paid on salaries payable to non-resident will not be allowed a reduction. It will be disallowed. And if TDS has not been deducted in respect of salary that has been paid to the non-residents where TDS is required to be deducted but not deducted, then it will be disallowed. 40a subsection 4 deals with payment made to the provident fund or superannuation fund or gratuity fund where TDS is not deducted, it will be disallowed. 40a 4. Now 40b is what? 40b is any remuneration or any salary or remuneration that has been paid to the partners. Here the limit is for first 3 lakh rupees of book profit. For first 3 lakh rupees of book profit, 1,50,000 rupees or 90% of the book profit, whichever is higher, and on balance book profit 60% of the book profit will be paid as a remuneration to the partners. Excess of that amount will be disallowed and will be added to the profits and gains from business or profession. Here, what is book profit? Book profit is net profit as per profit and loss account plus certain additions plus certain deductions, certain adjustments. Then we will get the book profit for the computation of remuneration. Next, any salary that has been paid excess of 12% will be disallowed. And here salary, any loan that has been obtained from the partner where interest is required to be payable, and any interest that has been required to be paid to the partner, then net interest will be allowed as a reduction. Any loan that has been obtained by the firm from the partner where interest is required to be payable in representative capacity, then such interest will not be subject to 12% limit. Even the interest can be paid more than 12%, it will be allowed a reduction for the firm. Next, 40b 40 small b small a is any remuneration or any salary that is paid to the members of association of persons or body of individuals will be disallowed in the hands of association of persons or body of individuals. It will be taxable in the hands of members. Next, 40a subsection 2. 40 capital A subsection 2 is any payment that has been made to related parties in excess of the any payment that has been made to related parties will be disallowed if it is excessive of the normal permissible limits, or if it is not at arm's length price, then it will be disallowed. Next, 40 subsection 3 is any expenditure that has been incurred, that has been paid in cash in excess of 10,000 rupees in a single day for a single person, then single day in a single person, then the excess amount will be disallowed and it will be added to the profit and gains from business or profession. Here, respect of transport business 35,000 rupees, limit is 35,000 rupees. 40a subsection 4 is any 40 section 3A is any past year expenses that has been paid in cash excess of 10,000 rupees will be disallowed. Up to 10,000 rupees the person can pay in cash, no problem. For political parties electoral trust, it is only 2,000 rupees. Next 40A 3A 40A 3A. Next 43B. 43B is reduction in respect of reduction is allowed only on payment basis. There are certain expenses where reduction is available. The expenses that are incurred by the assessee during the previous year will be allowed a reduction only on payment basis. That includes rates and taxes. Rates and taxes contribution. Any contribution that has been made to Provident Fund, Superannuation Fund, Gratuity Fund, or any other fund, and any commission or bonus that has been paid, and any interest on loans or borrowings, and in any interest on loans or borrowings, and any profit in lieu of salary, and any payment that has been made to railways. All these expenses will be allowed a reduction only on payment basis only. Will be allowed a reduction only on payment basis only. And here the thing is will be allowed a reduction of 43B on payment basis only under section 43B. Proviso is it should be paid before due date of filing of return of income. Explanation: if it is already claimed on accrual basis, will not be allowed again allowed on due basis. And explanation: interest, if the interest amount is converted into loan or borrowing, then it will be allowed a reduction only when such converted interest has been paid by the assessee. Then only it will be allowed a reduction. Next, sales tax liability. Sales tax liability, if it is deferred principal portion and interest portion. Principal portion, if it is deferred sales tax liability, if it is the deferred sales tax liability is treated as actual liability that has been paid as per the sales tax as per the respective act, then it will be allowed a reduction on payment basis only, on deferment basis only. In respect of interest, it will be allowed a reduction only when the interest is actually paid to the government. It will be allowed a reduction. In respect of section 44. In respect of section 44 AA, section 44 AA deals with compulsory maintenance of books of accounts. This is related to specified businesses, non-specified businesses. So specified provisions relating to specified provisions are provisions that have been specified there. Those provisions, if the specified provisions, IT professionals, gross receipts, in respect of existing provisions, in respect of new provisions, in respect of existing provisions, gross receipts for the 3 preceding financial years exceeding 1,50,000, more than 1,50,000 rupees, then books of accounts are required to be maintained compulsorily. And if newly set up provisions, if it is for the current previous year, if the gross receipts are greater than 1,50,000 rupees, then in that situation, books of accounts are required to be maintained mandatorily. Next, in respect of in respect of non-specified businesses, non-specified professions, in respect of business, in respect of profession, in respect of business, in respect of existing businesses, if the turnover or gross receipts for the 3 preceding financial years at any time during the 3 preceding financial years exceeds 25 lakh rupees, Pgbp income greater than 2,50,000 rupees, or turnover exceeding 25 lakh rupees in the 3 preceding financial years, previous years, then it has to maintain books of accounts. In respect of existing businesses, if it exceeds 2,50,000 rupees, or Pgbp income exceeds 2,50,000 rupees, or turnover exceeds 25 lakh rupees that year, then it has to maintain books of accounts. And in respect of newly set up others existing and others in respect of individual and achieve that one. In respect of others, if in respect of existing, if the business expense, the income that has been incurred earned by the assessee is exceeding 1,20,000 rupees, 1,20,000 rupees, or total receipts exceeding 10 lakh rupees during the previous year, then it has to during the three previous years preceding the previous year in which eligibility is required to be checked, then it will be books of accounts are required to be maintained mandatorily. And in respect of newly set up businesses, total income exceeds 1,20,000 rupees, or gross receipts exceeds 10 lakh rupees in that year, it will be allowed as books of accounts are required to be maintained under section 44 capital A. Next, now we'll go to section 44 capital A capital B, that is tax audit. Tax audit is mandatory in respect of individuals. Tax audit in respect of business, in respect of profession. In respect of business, if the gross receipts or gross turnover during the previous year, where cash receipts or cash payments during the previous year is less than, if the cash receipts or cash payments during the previous year is less than 5%, we can say is less than 5% of the total receipts or total payment that have been made during the previous year, then in that situation they are not required to maintain, they are not required to get the turnover limit for tax audit is 10 crore rupees. Otherwise, turnover limit for tax audit is 1 crore rupees. If the gross turnover exceeds 1 crore rupees, then tax audit is required to be done. And in respect of presumptive business, in respect of presumptive business under section 44 AD, if the turnover is exceeding up to 2 crore rupees, and presumptive income is 6% or 8% of the turnover, if the assessee is not required to provide income as per presumptive basis, which is less than 6% or 8% of the turnover, then he is required to get his books of accounts audited. In respect of profession here, if the turnover for the year exceeds 50 lakh rupees during the previous year, then they are required to get books of accounts audited. In case of presumptive taxation, in case of profession, part 4 ADA, if the income that has been offered for tax is less than 50% of the turnover, then 50% of the turnover, then they are required to get their books of accounts audited. Here no expenses will be allowed a reduction against the presumptive income under section 44 AE. Also, if the person is required to provide the income which is less than the presumptive income that have been prescribed under section 44 AE, then also person is required to get his books of accounts audited. Next, in respect of what is the penalty for not getting their books of accounts audited, 0.5% of the turnover of 1,50,000 rupees, whichever is lower will be leviable as penalty. And here there is an option available for the assessee to get the revised tax audit, to make the revision of tax audit report, where any after filing of tax audit report subsequently, if there is any expenditure that has been disallowed, as a result of which the income has to be recomputed, then income will be recomputed accordingly by making revision in tax audit report. Next, presumptive taxation under 44 AD, 44 ADA, 44 AE. 44 AD it is available for resident, individual and HUF, and turnover limit is up to 2 crore rupees. Income that is offered for presumptive taxation is 6% of the 8% of the turnover. If the cash receipts or if the receipts or payments are in electronic mode, then 6% of the turnover will be offered for presumptive taxation. And the person has opted for presumptive taxation, then he has to follow the scheme. He has to opt for the scheme for the next 5 successive previous years. And if the person wants to opt out from the presumptive taxation, once he have opted out, then he cannot re-enter the presumptive taxation scheme for the next 5 years. And next, again no expenditure will be allowed a reduction against the presumptive taxation income. And against the presumptive taxation income, books of accounts are required to be maintained by the assessee. If the assessee wants to declare or provide income which is less than the income that is required to be provided under 44 AD and 44 AD, and advance tax is required to be paid on 15th March of relevant as a previous year. Now we will go to section 44 ADA, that is in respect of profession. In respect of profession, it is available for resident, individual and HUF, and resident, individual and HUF other than LLP. Presumptive taxation limit for profession is up to 50 lakh rupees. Up to 50 lakh rupees. Gross receipts are up to less than 50 lakh rupees, up to not less than 50 lakh rupees. if it exceeds or more than or equal to 50 lakh rupees, then presumptive taxation is not applicable in case of professionals. And presumptive income that is offered for presumptive taxation is 50% of the gross receipts. No expenditure is allowed against presumptive income. If the person has opted for presumptive taxation, then a person has to follow the presumptive taxation scheme for the next 5 successive previous years. And if the person has opted out from the presumptive taxation, he cannot again re-avail the presumptive taxation scheme for the next 5 assessment years, 5 successive previous years or successive assessment years, as the case may be. Next, the person has to pay his advance tax on 15th March of the relevant previous year. Next, in respect of 44 AE, that is assessee who is engaged in plying, hiring and leasing of goods carriages. Goods carriages are divided into two categories: light goods vehicles and heavy goods vehicles. Light goods vehicles, what are light goods vehicles? Heavy goods, first we will take heavy goods vehicles. Heavy goods vehicles means the goods carriages whose gross weight or gross tonnage is more than gross weight or gross tonnage is gross weight or gross tonnage is more than 12 tons. Then it is called as a heavy goods vehicle. If it is a heavy goods vehicle, then tonnage income that has been provided for tax provided as income is 1000 rupees per ton into number of per month 1000 rupees per ton into 12 tons into number of vehicles into number of months per month or part of the month, as the case may be, will be offered for presumptive taxation. If it is light good vehicles, all vehicles other than heavy goods vehicles will be light good vehicles. 7,500 rupees per month or part of the month into number of vehicles will be offered as income under presumptive taxation for light good vehicles. And the person who is carrying on insurance business or the person who is carrying on trading or commission agents cannot avail presumptive taxation scheme. The person has to pay advance tax in four installments in the previous year. And here deduction is here one thing you have to remember: partners remuneration and salary. In respect of partners remuneration, interest and remuneration will not be allowed in respect of section 44 AD, section 44 ADA, but it will be allowed under section 44 AE, 44 AD. This is a special point here. Next, it will be allowed a reduction under section 44 AE. Now we will go to section speculative business. So what is speculative business? Speculative business is a business which is a specified business, specified business where the income from speculative business which is used for the purpose of trading in securities and derivatives, and income from speculative business can be allowed to set off any losses from speculative business can be allowed to set off against profits from the speculative business. So speculative business is divided into following categories, that is related to hedging, related to derivatives, related to forward contracts and option contracts. Hedging contracts that have been taken for the purpose of goods, hedging contracts that have been taken for the purpose of services, and hedging contract that has been taken for shares and forward contracts, and derivative trading contracts and commodity derivatives. Here these will not be considered as speculative businesses. So these will not be included. Speculative business that does not include all these category of businesses. Next, we'll go to section 73. That is any losses from speculative business can be set off against profits from speculative business. It can be carried forward for 4 assessment years. And in case of section 41, that is deemed income, in case of remission or cessation of any trading liability on any other liability previously, if any amount has been recovered from that remitted or cessation from that liability or trading liability, it will be deemed to be the income in the previous year in which it has been received. And section 43 deals with the income of public financial institutions and public financial corporations and insurance companies. Income by way of interest on assets recognized, loans and advances bad and doubtful shall be chargeable to tax in the previous year in which interest is credited, or the profit and loss account are actually received, whichever is earlier. Actually received whichever is earlier. Next, these are related to this is related to presumptive taxation. Now we will go to specified deduction. So specified deduction that is available for the individual. Section 33AB, 33ABA. 33AB deals with tea, coffee and rubber business. Tea, coffee and rubber businesses. Here it is available for individual, resident individual and HUF. The deduction that is available is 20% for 40 amount that has been deposited to the tea, coffee and rubber development account, or 40% of Pgbp income, whichever is lower will be allowed a reduction. Here, what is the mode of computation of income? First we have to take net profits as per profit and loss account. From that we have to reduce reduction that is available under 33AB. Then we will get net income. That net income has to be divided between agricultural income and taxable business income. As this has been provided under Rule 7. It has been provided under Rule 7, where in case of rubber business, in case of tea business, in case of coffee business, in respect of rubber business, so 35% of the income will be considered as business income, and for 65% of the income will be considered as agricultural income. In respect of rubber business, in respect of tea business, so 40% of the income is business income and 60% of the income is agricultural income. In respect of coffee business, where coffee beans are queued and manufactured and queued, then 75% of the income is agricultural income, 25% of the income is business income. In respect of coffee beans which are queued, roasted, manufactured, grounded, then in that situation 40% of the income is business income, 60% of the income is agricultural income, and amount that has to be deposited to the special reserve account. And what are the situations where the amount can be withdrawn from the special account? It is in cases of death of the assessee, or in case of closure of the business, or discontinuance of business, or liquidation of the business, or in case of liquidation of the business. So in all these cases, amount can be withdrawn from the special account if amount has been withdrawn. If the amount has been withdrawn, which is from the special account, and it is unutilized, and it will be deemed as PG income under the head profits and gains from business operation. If the amount has been withdrawn on account of death of the assessee, or on account of liquidation, on account of discontinuance of business, then it will not be taxable. It will not be chargeable to tax under PGP. And withdrawal for any withdrawal that has been made for purchase of the asset, it will be allowed a deduction. But the asset does not include following type of assets: assets against which deduction under 35 series 100% reduction is allowed. Those assets will not be purchased. And as expenditure that has been incurred in respect of second hand plant and machinery, expenditure that has been incurred in respect of ACs, and in respect of ACs that are installed in the office premises, or plant and machinery that has been imported into India. Other than this plant and machinery, remaining plant and machinery assessee can purchase out of funds that have been borrowed from the special reserve account. And amount withdrawn, assets that have been sold, assets that have been acquired, sold or transferred within 8 years, then in that situation the amount that has been received, the sale proceeds that have been received, or minus the deduction that has been previously allowed, excess amount will be chargeable to cost as allowed a reduction in case of suction of the business. So this is section 33A. It will be deemed as income. Next 33ABA. 33ABA is what? 33ABA site restoration fund. Site restoration fund, it is available for resident individual and HUF, and prospecting, extraction, production of natural gas and LPG. Natural gas amount that has been deposited to the special reserve account is amount deposited at 20% of Pgbp income, and remaining points are same as section 33AB. Next, section 33AB, 33ABA, section 35. Section 35 deals with what? Section 35 deals with scientific research expenditure. Scientific research expenditure, the expenditure that has been incurred in respect of in-house research, in respect of contribution to others, in respect of in-house research, in respect of own business, where expenditure that has been incurred prior to the commencement of the business, after commencement of the business, expenditure that has been incurred prior to the commencement of the business, if it is capital expenditure, if it is revenue expenditure, if it is capital expenditure other than land, remaining expenditure will be allowed as a reduction for 100% for the previous 3 years, for the preceding 3 years, in the year in which the business has been commenced by the assessee. In respect of revenue expenditure, 100% of the expenditure will be allowed as a reduction. The revenue expenditure will include salaries and wages and materials that have been purchased will be allowed a reduction. In respect of expenditure that has been incurred after commencement of the business, capital expenditure and revenue expenditure. Capital expenditure other than land, remaining amount will be allowed a reduction. 100% will be allowed, and revenue expenditure 100% of the amount incurred will be allowed a reduction under section 35. Under section 35 subsection 1. Next 35 subsection 1 clause 1. 35 subsection 1 clause 2 is any contribution that has been made to other research association, institute, college, university for carrying out social research, so scientific research. 100% of the expenditure incurred is allowed a reduction. Any contribution that has been made to research institution, college, educational institution or university for social and statistical research under 35 subsection clause 2a will be allowed as a reduction. 100% will be allowed a reduction. 35 subsection clause 3 is any contribution that has been made to national laboratory, Indian Institute of Technology will be 100% of the expenditure incurred will be allowed. Contribution that has been made is allowed a reduction. 35 subsection 1 clause 3. Next 35 subsection 1 clause 2 clause 3 is Indian companies. 35 subsection clause 4 is national 2AA is national laboratories and Indian Institute of Technology. In respect of 35 subsection clause 3 is any Indian companies that are involved in scientific research. Any contribution that has been made to Indian companies, 100% of the expenditure incurred will be allowed a reduction. In respect of 35 subsection 1 clause 2AB, where the company is engaged in biotechnology business, so any expenditure that has been incurred, where expenditure is divided into two categories: revenue expenditure, capital expenditure. Revenue expenditure, 100% of the expenditure will be allowed a reduction except land and building. In respect of capital expenditure, 100% capital expenditure, 100% of the expenditure incurred will be allowed a reduction except land and building. In respect of revenue expenditure, 100% of the expenditure incurred will be allowed a reduction. Next we will go to here these institutes has to be recognized by the CBDT. If the recognition has been cancelled subsequently, then contribution that has been made earlier will be allowed a reduction, even though the recognition of the institute has been withdrawn subsequently after the contribution that has been made by the assessee in respect of these institutes. And any reduction that is unabsorbed in respect of scientific research expenditure can be allowed to set off carried forward for the future years and can be set off against any income of the assessee. Scientific research expenditure income only. Order of set off is current year and against any other income. Order of set off is current year scientific research. Next depreciation, current year depreciation. Next current year brought forward losses, current year unabsorbed brought forward losses, unabsorbed depreciation, and unabsorbed scientific research expenditure. 35 subsection 1. Next, that is section 35AB. If the asset that has been acquired, and the scientific research has been sold subsequently by the assessee, then in that situation, the sale proceeds are greater than the deduction allowed, and the sale proceeds are less than the deduction allowed. If the sale proceeds are used, WDV for the actual cost of the asset will be nil, and in that situation amount recovered will be taxable under section 41. In respect of it is less than the deduction allowed, then lower of sale proceeds or deduction allowed under 35 subsection clause 4 will be taxable under 41 subsection 3. Balance sale proceeds in excess of the deduction that is allowed, excess amount will be chargeable to tax under capital gains under section 50. Next, assets that are purchased for scientific research is transferred to or sold to another business. Sale proceeds are greater than the amount of proceeds, then excess amount will be taxable in the previous year in which the sale took place. Next, section 35ABA. 35ABA is any expenditure that has been incurred in procurement of telecom licenses, right to use of spectrum and telecom license. And 35ABB is any expenditure that has been incurred in respect of procuring of telecommunication for telecommunication business. Expenditure that has been incurred will be allowed a reduction. 1/10 of the expenditure will be allowed a reduction, and 1/10 of the expenditure will be allowed a reduction, and this is available for capital expenditure pro rata basis. Number of years license fees paid for the commencement of the business. Other case, if the license is paid for commencement of the business, then the previous year in which before commencement of the business, the previous year in which the business has commenced, it will be allowed a reduction. In respect of in the previous year in which amount has been paid, will be allowed a reduction. License is transferred. The license is transferred subsequently. Then the sale proceeds are greater than the unamortized balance of license fees. There, in that situation, the sale proceeds that have been received or sale proceeds that have been received, or total sale proceeds minus unabsorbed amount, unamortized amount, or reduction that has been allowed, whichever is lower will be taxable under the head Pgbp. In respect of 35 ABB, if the sale proceeds are less than the unamortized balance of license fees, then if whole of the license has been transferred, then in the situation that deficient amount will be allowed a reduction. If the part of the amount is transferred, then the deficient amount will be the deficient amount will be allowed a reduction over the remaining years of license, and the same treatment is available in respect of 35ABA, that is telecom license expenditure that has been incurred on acquisition of spectrum and telecom license. Next, ABB 35AD. 35AD is what? 35AD is any investment linked deductions. Investment linked deductions are investment that has to be made in specified businesses. So 14 specified businesses that have been discussed already, provided in the Income Tax Act. Expenditure that has been incurred is 100% of the investment that has been made is allowed as reduction. And here expenditure incurred will be allowed as reduction, and capital expenditure, revenue expenditure 100% is allowed. Capital expenditure except goodwill, land, financial instruments will be 100% will be allowed as reduction. Expenditure incurred prior to the commencement of the business will be allowed as reduction in the previous year in which the business has been commenced. It has to be capitalized in books of accounts, and audit report has to be furnished. Next, conditions are it should not be found by splitting up or reconstruction of existing businesses, and plant and machinery should be new plant and machinery. However, the plant and machinery up to 20% of the total plant and machinery can be imported plant and machinery, and loss from specified business can be allowed to set off against profits from specified business. Allowed profits from the specified business only, and the asset has been sold before the specified login period. Then if it is sold then the sale proceeds minus the WDV value of the asset will be the sale WDV will be nil. Special business WDV will be nil. The sale proceeds will be taxable as income under the head Pgbp under section 28, clause 6, clause 7, and in respect of asset has been transferred to other business, non-eligible businesses. Then in that situation, if the sale proceeds minus notional asset value, total asset value, total reduction that has been allowed minus the notional depreciation, the WDV value has to be reduced from the total sale proceeds. The excess amount will be deemed as income under 35 AD subsection 7 capital A. Next, 35 CCD, 35 CCD is any contribution that has been made for agricultural extension projects. It is available for all type of assessees. Will be allowed a reduction. 100% will be allowed a reduction. Revenue expenditure 100%, capital expenditure 100% except land. In respect of 35 CCD, notified skill development projects only applicable for companies. 100% of the contribution that has been made is allowed a reduction. Revenue expenditure 100% is allowed a reduction. Capital expenditure except land 100% will be allowed a reduction. In respect of 35D is what? 35D is amalgamation and demerger expenses. Any expenditure that has been made in respect of amalgamation and demerger, 1/5 of the expenditure will be allowed a reduction. 35DD, 1/5 of the expenditure will be allowed a reduction for the 5 successive previous years. 35DDA, that is amortization of expenditure on voluntary retirement scheme. 1/5 of the expenditure will be allowed a reduction for that year and for the next 4 successive previous years. successive previous years. 35 DDA. Section 35E is a preliminary expenditure that has been incurred by the assessee. Preliminary expenditure, what is eligible preliminary expenditure? Expenditure that has been incurred on printing of MOA and AOA and preparation of project report, and expenditure that has been incurred on formation of businesses, issue of share issue expenses. So all these are preliminary expenditure. These are eligible expenditure, and what is the amount of deduction is the total preliminary expenditure that has been incurred. 5% of the cost of the project. 5% of the cost of the project or capital employed. 5% of cost of the project or capital employed, whichever is higher, or actual preliminary expenditure has been incurred, whichever is lower will be allowed as a deduction. Whichever is lower will be I think that one only. 1/10 of the qualifying expenditure or 1/10 of the qualifying expenditure or 1/10 of the expenditure of expenditure. 1 minute. E is amortization of expenditure on prospecting and extraction of mineral oils. Mineral oil includes petroleum and natural gas. Here, 1/10 of qualifying expenditure, 1/10 of the qualifying expenditure will be allowed as reduction. Or expenditure whichever is lower will be allowed a reduction, or income for the previous year whichever is lower allowed a reduction. Unallowed expenditure can be carried forward and added to the next installment. Next Section 35D is amortization of preliminary expenditure. 35D is amortization of preliminary expenditure. Preliminary expenditure we have already discussed. This is actual preliminary expenditure that has been incurred. Actual preliminary expenditure 35D, that is 35D. Preliminary expenditure, the 5% of the cost of the project or capital employed, whichever is higher, and actual preliminary expenditure whichever is lower will be allowed a reduction. Whichever is lower, 1/5 of the expenditure over the period of 5 years. 1/5 of the expenditure or 5% of the cost of the project or capital employed, whichever is higher. Of these two, whichever is lower will be allowed a reduction. Next, in respect of Section 37. Section 37 deals with general deductions. Those expenses that are not allowed as deduction under 30 through 36 are allowed a deduction under 37, provided that these should not be in capital nature. They should not be a violation of law, violation of any act, violation of provisions of the act, or violation of law, infraction of law. Then it will be allowed. It should not be illegal nature. Then it will be allowed a reduction. Any medical fee that have been provided to the doctors will not be allowed as reduction. Any CSR expenditure will not be allowed as reduction. Any regulation fees that have been paid will not be allowed as reduction. Any amount that has been paid for medical treatment of the director, heart surgery will not be allowed a reduction. Expenditure which are personal nature will not be allowed a reduction. Expenditure which are illegal nature will not be allowed as reduction. And expenditure which is capital in nature will not be allowed as reduction. General expenditure, other expenditure which is not allowed as reduction are dividend distribution tax, secret commission to be paid to the Gundas, contribution to the electoral trust, other donations, provision for the loss of subsidiaries, provision for deferred tax or income tax, provision for unascertained liabilities, provision for diminution in the value of the assets, provision for gratuity, even based upon the gratuity valuation, share issue expenses, even based upon the gratuity valuation, share issue expenses in case of IPO, FPO, rights issue, declaration for compounding fees, expenditure incurred on project which is not related to existing business or abandoned project, or payment to the consultation of consultant for the opinion of the business, or expenses incurred relating heart surgery of the Indian Association, any commission that has been paid to the doctors by the diagnostic centers for referring of patients, tax on monetary purposes of employer, employee, income tax, advance tax, TDS, interest on income tax or TDS or advance tax, penalties, other penalties, that is infraction of law, violation of law, will not be allowed a reduction. What will be allowed a reduction is provision as per fair estimate or reasonable certainty, as per ICDS. Gratuity paid is allowed a reduction. Share issue expenses, buyback and bonus issue will be allowed a reduction, and debenture issue expenses will be allowed a reduction. Discount on issue of debentures allowed a reduction. Sponsorship fees, non-compete fees, expenditure on gloves and boards, expenditure on grant of ISO certificate, loss on theft and incidental to business is allowed a reduction. Fees for delayed filing of TDS statements will allowed a reduction. Tax on GST, excise duty, custom service tax will be allowed a reduction, and interest on sales tax, GST, customs will be allowed a reduction. Other penalties which are not the form of infraction of law but contractual in nature will be allowed a reduction. Now we will go to section 42. Section 42 deals with what? Section 42 deals with special provisions relating to deduction of prospecting for mineral oils. That is concessional arrangement where contracts are entered by central government. Interest entered into prospecting, extraction and production of mineral oils. Expenditure of infrastructures are about in nature. Here, before commencement and after commencement of production, quantum of deduction that is available is same as 33 AB, 33 ABA, 33 ABB will be allowed. Quantum of deduction will be allowed a reduction. Some of expenses that have been incurred over a period will be allowed a reduction. Section 43C. Section 43 is the computation of cost of acquisition of certain assets. Cost of acquisition of certain assets. Here, if the assets have been transferred by the amalgamating company to the amalgamated company at a revalued price. After revaluation, means capital asset is converted to stock in trade plus revaluation, and revalued asset is transferred to amalgamated company, then section 43C is applicable. Capital asset is converted into stock in trade, and it is capital asset is revalued and converted into stock in trade, and it has been transferred, then it will be section 43C is applicable. Capital asset is converted to stock in trade and it has been transferred to amalgamated company, then it is revalued. Then section 45 subsection 2 shall apply. Section 43C will not be applicable. Here sale manner cost of acquisition is profits and gains from business or profession. Cost of acquisition will also include cost of improvement. Next, this will not include full any assets that have been incurred on partition of HUF, gift or will or irrevocable trust or sold as stock in trade or full or partial partition of HUF will not be allowed a reduction. Section 43. Section 43CB is what? Section 43CB is income from construction or service contract. This is divided into two categories: construction contract, service contracts. Construction contracts, the income is calculated based upon percentage of completion method. Percentage of completion method, that is percentage of contract revenue, contract cost, and in respect of service contracts, this is divided into two categories: project completion method and project completion method and straight line method. Project completion method is if the contract period is less than 90 days. Straight line method is if the contract period is more than 90 days. Here contract revenue includes retention money also. Contract cost shall not reduced by the incidental revenue in the form of interest, dividend or capital gains. Contract expense includes contract revenue includes retention money also. 43CB. This is section 43CB. And what are the left out of sections here is 44A. 44A is any 44A and 44AA. 44A is any foreign exchange fluctuations that are gain or loss that are arising from purchase of the capital asset in foreign currency. Foreign currency will be adjusted. The foreign exchange gains or losses will be adjusted against the cost of the asset. 44A is foreign exchange fluctuations that are arising on loans and borrowings from foreign currency. These are divided into three categories: monetary items, non-monetary items. Monetary items, this will be respectively adjusted accordingly depending upon the type of asset. It should be adjusted. Now, what are the remaining sections? 43B completed, 43C completed, 43D also completed, 44AA, 44AA, section 44. Yeah, as for other presumptive taxations will be other presumptive taxation incomes will be dealt in non-resident taxation. Okay, as far as now all the sections have been completed relating to PGBP. Further sections and further chapters we will discuss in the further sessions. Thank you.